hop over from asset class to asset class, which also helps me filter deals very easily. I look at class B, maybe C plus opportunities and markets with strong fundamentals. Ideally 1990s and your 150 plus or minus units. So when a deal comes across my desk, if it doesn't fit those parameters, like, right, if I got a self-storage deal or maybe I got a brand new development deal, that automatically, right, will drop off the list. And so assuming my initial, what I call qualitative criteria are there, which you can very quickly scan, right, an email or a deck for that information, that's where I really go into the numbers. And the investment offerings typically have sufficient information to allow me to poke through some of the numbers and figure out, does this meet my criteria for positive cash flow, conservative assumptions? And I'm happy to dive a layer deeper into those, what those mean. And assuming that checks out, then I would ask the sponsor for their underwrite. I used to be a little bit more flexible and accept PDFs. I no longer do that. So if they're not able to share with me the full underwrite in Excel unlocked, then it's a no-go. It's a hard no for me because I need to have that transparency and see exactly how they underwrote it, what assumptions they made, what level of detail did they underwrite the deal into. And then assuming all that checks out, then really my last step would be to review the PPM because the deal structure is just as important. And I've had cases before where the sponsor checked out, market checked out, deal was okay, but then I didn't like the legal structure. So I walked on a deal. So that was just as important. So that will be like the last step. And if everything aligns, then I'm ready to proceed to the next step. So I know this was a high level step-by-step overview, but I can dig into each of these topics deeper if you'd like.
Very understanding the way you put it. Would that be a deal you look in when you say if you want to put it forward? Would that be something you look in to invest as an LP? And
Mhm.
that's what you're talking about? Okay.
Both as an LP, but I also work with high net worth investors, family offices. So oftentimes they approach me to help them diversify their portfolios by connecting them to these well-vetted cash flowing investments in apartments. And so I do invest passively, right, as an LP, but I also connect right with sponsors at the co-GP level. So that's typically how I enter deals when I have other people's capital coming alongside with me.
I see. Yeah. Okay. Yeah, that's what I was trying to understand there. Okay.
Mhm.
Well, from a lender's or underwriter's perspective, what separate a deal that gets serious attention from one that gets passed over?
So the process is actually very similar. Well, the process I follow as an investor is very similar that I used to follow as a lender, right? Making those decisions. And it really starts with the people, right? Who is the borrower? What is their track record? How do they communicate? So that's really the first step is having that relationship, but really feeling confident in that team's or that person's ability to execute on the business plan. Because the lender, right, thinks throughout is very similar to an investor, right? Our primary goal is investors is to protect the principal, right? Not lose money, as Warren Buffett likes to say. It's very similar for a lender. They're looking to protect the principal and focusing on the downside. The two key differences probably are the lender is more conservative, right? They focus more on the downside, the risks, how they're mitigated. As from an investor's perspective, that's also important, but as investors, we also need to look at the profit, right? You're doing a lot of work, especially if you're on the active side, or as a passive LP, you're putting your capital to work, so it can work harder, right, for you. So the upside potential is just as important. But like I said, it starts with the borrower and the people. Then the lender, of course, would dig deeper into the numbers. Definitely, they would look at the historical performance and where the deal is today. That's how they underwrite. They will ask for projections because that gives them clarity into the business plan, how you think about it, how you intend to execute on it. So it's not uncommon for them to ask for projections, but the way they would underwrite, especially a stabilized deal, is based on the current cash flow that it is producing today. Obviously, slightly different if you're looking at like a new construction deal or maybe short-term bridge deal, where cash flow may be challenged or non-existent, right? So in that case, they will definitely be putting a lot of onus on the pro forma cash flow and absolutely on the executional ability of the sponsor and their track record. And last but not least, they will stress test the numbers, right, to really understand where the downside lies, because that, along with all the typical diligence they go through to approve a deal, will really help determine how much do I lend and under what terms.
Okay. All right. Guys, if you guys have questions, go ahead and put them in the chat as well. And also you share your contact information for something. There might be somebody in the audience that may, and if you have something you're looking for, put it in the chat as well. Someone may be able to help you. So now, thinking like an underwriter, how
Mhm.
can sponsors start thinking more like an underwriter instead of just an investor? Because many times you see a deal, and
Mhm.
especially people who are more on the investor relation side, and like they see the deal, okay, it's a good deal. We see what we can get with the deal.
Mhm.
However, the next thing some people maybe, especially if you're on the investor relation team, you're like, okay, you start thinking about who I can reach out about the deal. But
Mhm. Mhm.
coming with an underwriter perspective could also be a great thing to do. So what's the best way you think these people should have that kind of thinking? Should approach
Probably
it?
the key distinction I would add here is risk management, thinking through the risks of the deal, if and how they can be mitigated. Again, a lot of it boils down to the inside. And as a lender, I used to get paid to take risk, right? I mean, that's just the nature of the business. As investors too, we get paid to take risk, but I feel that that is often overlooked because people are so focused on the shiny objects, right, and the profit and the dollars and cents. And of course, like I said, that's important, but risk is not to be ignored. And I like to say that the one guarantee I can make to investors is that there is always risk in a deal and the probability, right, of losing your money. And a lot of times, I feel like there is a misconception out there that says, oh, high risk, high return. And yes, absolutely, you should get compensated more if you're taking on more risk. But it almost implies that that return is almost guaranteed coming with that higher risk profile investment, which is not the case. In fact, the way I would think about it is higher probability of loss, right? So a deal that has maybe 30% IRR, I think through it. I think about it as a deal that has a 30% chance of loss versus a deal that has a 15 IRR, right? Maybe has a 15% chance of loss. And obviously, this is not a one-to-one ratio in any way, but that's one key distinction. And I can tell you, in this, I mean, at this point, it's been multiple years. I've seen maybe one, maximum two, one that I can recall, investment offering presentation that has a slide on the key risks, right? And of course, the PPM has the 40 pages of anything and everything that can go wrong with the property, which every investor should read and understand. But I'm not talking about that. I'm talking about from a sponsor's perspective. Walk me through the 3 to 5 things that can go wrong with this property that can blow up this deal, and how do you think these risks are mitigated, or what are you doing today before you enter into the deal, right? To think through plan A, B, and C if things were to go wrong.
Right.
Not suggesting this is a perfect solution, right?
Right.
But at least it helps. It's not going to eliminate the risk of loss. And that's what I mean by when I say not a perfect solution. It doesn't eliminate the risk of loss, but it minimizes it. So that's probably the one key distinction that comes to mind as far as how to answer your question. How do you think more like a lender or put it through the underwriting lens as you evaluate those new investment opportunities?
That's right. That is exactly the point of this session today. It's like as investors, we should be thinking more as a lender. That way, that get us closer at the table to get that
Mhm.
that funding, right?
Yeah.
So being like you're saying, being proactive, like an avid thinker, hey, if this goes wrong, what next? What do we do? And if thinking of it ahead of time, but not seeing all the roses because even the roses have spine, right? So you
Mhm.
have to look at both ways.
Mhm.
Um, Another question, what are the red flags that make you pause or question a deal right away?
Oh boy, a big one. I mean, it's always been, but especially these days, is the exit cap rate compression. And you could say this could be a philosophical difference, right? If you're an investor who firmly believes that cap rates will reduce drastically, that long-term rates will collapse, yes, that's how you're going to underwrite a deal and assume that exit cap rate compression. Based on what I see today, and we can definitely talk about what that is for me, but based on the environment that I see today, I just don't see that coming. And what a lot of investors also forget is that, yes, the Fed may be lowering rates, but these are short-term rates. What really drives the cost of borrowing are long-term rates, specifically the 10-year Treasury. So I follow that very closely. I follow macro events, geopolitical events, and supply demand dynamics. Obviously, cap rates are not solely influenced by the trajectory of interest rate. There are a lot of other factors that drive cap rates. But based on everything that I see today, my own thought process points to higher for longer. And maybe we get to a 3-4% cap rate environment again. Who knows? But I just don't see that. And because of that, again, as an investor, I don't want to speculate. That's just based on my own risk tolerance. Of course, everyone's risk tolerance is different, but I prefer not to speculate. So in that case, when I look at a deal, I would always underwrite to a cap rate expansion. And best case, if there are a lot of other cushions and levers in the deal, maybe flat exit cap rate. That's like the best case scenario. Like I said, assuming there are other cushions I can lean on. So that's a hard no for me because cap rates have a multiplier effect, right? That's you can think of it as the inverse multiplier or the inverse of the PE ratio, right? If you're a stock and market investor, and it's really, really hard to fight that battle. I mean, the only way to fight it is really if you exponentially improved NOI and then maybe you break even on your exit valuation. So if that's wrong, your deal is set up for failure right off the bat, again, unless you over exceed the projected NOI performance. And then another hard no for me, which also has a pretty um, big impact on the deal performance, is the rent assumptions, right? Why? Because everything flows down from the top line. So if you get that wrong, not only you're starting off from the wrong base, but you're compounding with the wrong number. So then it gets even worse by the time you get to exit. So if I see that rent growth or rent assumptions are far off from where the market is today, that's also another red flag for me. And then last but not least, I did say the structure. So there are certain provisions in the PPM that are a hard no for me, and alignment of incentives as well. So those need to be the LP and GP interests need to be aligned. So like 2 weeks or so ago, I saw a deal on the surface, right? It met my criteria. I opened the deck, and right off the bat, I see like a 10% acquisition fee. I'm like, what is that? Right. Of course, like the LP GP split was more favorable, but that to me is a hard no, because then sponsor gets paid at the beginning, right? And what's their incentive to fight for the deal if something goes wrong? The inverse is also true, right? I've seen deals where the sponsor, it's 90-10 splits, 1% acquisition fee, no asset management fee. I'm like, I need you to be adequately compensated, because if not if actually when things go wrong with the deal, right? I need you to be motivated, right? If you're not getting compensated, the easiest thing to do is let go. And some people are doing that today. So beyond just the underwrite and the numbers, the deal structure and alignment of incentives are big for me, and would cause me to walk away from the deal, even if everything else aligns.
Wow, that is big. And I think I totally agree. As a sponsor, you're getting paid, I mean, 10% for acquisition fee, that's huge. That's a lot. And then some people, they they're not getting compensated enough. And usually, to
Mhm.
me, the red flag in the ladder, it's possibly because the margins,
Mhm.
the person really trying to make that deal work.
Mhm.
So they're not being compensated. But as as somebody who's going into that deal, if I realize you're not being compensated, just like you said, I won't
Mhm.
put my money there because you're not getting paid for it. If you're not getting paid
Mhm.
for the work you are doing, so you're not encouraged, you're not motivated, you're not going to put the work.
Mhm.
And I
Mhm.
totally agree with that. Yeah, that's a big one. All right. But I think some people do it to show, oh yeah, I'm willing to work. I'm
Yeah.
willing to work. So and I
Yeah.
think that's the way they think people are gonna look at it. But who want to work for free? Nobody.
Yeah.
So
No, they need to be motivated. And I agree with you. Typically, in most deals where like they're really trying to stretch to get it to a profile that would be LP friendly on paper, right? But
right.
LP friendly on paper doesn't mean that the deal is well structured, and if the margin is not there, it's better to walk away from the deal, because then it looks great for on paper for the LPs, but then you're really counting on everything going right for the deal to work. And what if it doesn't? Then you have zero margin of error, and then you have to deliver bad news and all that. So I agree. Both are to me are equally important. So probably healthy balance is is what I target.
That is true. And I think when we were at BC, Anton and you and I, we had a long conversation about these things.
Yes,
So yeah, that was very interesting.
good.
So for someone earlier you talked about if someone bring you a deal, either
Uh-huh.
for you to invest or some other people to bring some other people into that deal. But I think this question is more towards the lender side. For someone
Okay.
to bring a deal as a lender to a lender, how should they present it so that it builds confidence from the start?
Mhm. So the very first thing is start with the people, right? Especially if you're brand new to the relationship, talk about who you are, what your background is, who your team is, what their specific roles are, and speak to your ability to execute, perhaps looking at past deals or other deals. Um, so track record and people, that would be first. It's actually a great thing when you ask a lot of questions and engage, because again, it shows the lender that you're thinking about it, asking about risk, asking about how they underwrite, how the approval process will work through, how they structure the deal, what are their sizing parameters or sizing process, because that helps you gain insight into their process, but it also shows them, hey, you're thinking through, right, the deal proactively. Then secondly would be the underwrite, and the deal, of course, share the full underwriting spreadsheet with them, but also maybe your view on the market. They're not going to be experts in all markets, right, across the US or even internationally. So show them your expertise, and a lot of that usually comes when you're focused, right? I sometimes see people jumping around different asset classes, deals, markets. So that raises a lot of questions for a lender, right? Are you a jack of all trades and a master of none, right?
Right.
And and especially with market focus, it's very important to have that boots on the ground presence. So maybe you're not located in the market you invest in, but you have a team member who is there, someone else on the general partner team. So speak to that, speak to their expertise, speak to the property management firm, right? You're managing the manager in most cases, right? You're likely not going to self-manage that property. And even if you're vertically integrated, you're hiring other people to do the day-to-day work. So speak to that aspect of it. And especially if you're vertically integrated, speak to the processes and systems you have in place. And a lot of that will tie into, right, the track record discussion and how the existing book of business is performing, the existing portfolio. And last but not least, the business plan. Why do you think this is a sound investment? And if that doesn't work out, like are you still able to cover the debt service and repay the lender? Um, that that follow-up comment that I'm about to make is probably not going to surface at the very first discussion, but eventually will come up in the conversation, right? Is your not only your experience level, which the lender would look at, and now, especially today, given current market developments, given increased level of fraud, lenders are digging in several layers deeper into what track record really means. But beyond that, they'll also look at your personal balance sheet. So it's not uncommon for them to request your schedule of real estate owned properties, your personal balance sheet statement, and really dig into what is your liquidity and what is your net worth, and is that sufficient to cover to meet their parameters, which in most cases it's 10% liquidity and net worth equals the amount of the loan. But in today's environment, not uncommon for them even there to dig deeper to really understand what's going on. So I'll pause here, but it really comes down to those key parameters and really bringing those up, hopefully earlier in the conversation, to give them the confidence that, hey, this is someone I want to partner with. And I say partner because yeah, they're not an equity investor in your deal, but the lender typically brings really the largest share of capital in today's environment. That could be anywhere from 50 to 65%, right, of the capital needed to close on the deal. So they're really a partner in this, and there are all sorts of lenders. I would just say it's almost like cowboy land out there. It's like they go from one end of the spectrum to the other, so they're not all created equal. So who you partner with also matters, right? Um, for you, I mean, my preference always has been with relationship lending. Now they're not always going to be the cheapest, but you also get what you pay for. There are also transactional lenders, right, who would or brokers who would churn the deal, and they're mostly focused on the transaction. But are they really the best long-term partner? And how will they react, right, during time of duress? Because like I said, they're not all of them are created equal, and some are funded through private investments, right, and private credit. And sometimes you may have heard the term loan to own. So they're out there. So for you as an investor or borrower, it's also important to understand their world and how they operate to ensure that it aligns with how you want to run your business and how you want to operate the deal.
All right, that sounds great. Guys, I hope you are taking notes, okay? Because there's a lot of gems being dropped in here right now. But most likely, I know for a lot of us, we work with a broker lender, right?
Mhm,
So
mhm.
that broker lender does have a lot of people, company that they work with. So that relationship you're talking about, so that will be with the broker lender, and the broker lender will pass it on to the lender for us, or are you saying we can translate that to our resume and the business plan?
Yeah, so the relationship, it could be either directly with the lender, right? If you already have that or looking to develop that. But I would say the same applies with the broker lender, right? Because at the end of the day, as an investor, right, you're looking for certainty of close. So you want to make sure that they have that track record of connecting you with lending partners who can actually execute on the deal and not surprise you when you're at the altar getting ready to get married and sign the papers and close on the deal. So that's just as important. And then, yes, on the flip side, you absolutely want the more confident, right, the broker feels in your ability to execute, the easier their job is, right, to find you the most competitive terms and really have confidence in you. And oftentimes, if they say no, or if you start getting similar feedback in terms of, hey, I can only lend, say, 50%, or these are the covenant, that's also a signal and probably should be a good reason for you to take a step back and understand, okay, what are they seeing that I'm not seeing, that may be creating elevated risk for the deal. So I would also take all of these conversations and the feedback you're getting through that dating process or prospecting process. I would also take that as another data point as you think, of course, during your diligence before you get into a deal, have I thought through anything? So again, going back to my statement, they're truly a partner, and that's how I view them.
Yeah, that is correct. They are a partner. They're part of your team. I mean, all those
Mhm,
people become part of your team.
mhm.
That is great. Let me see. I think I see some question in the chat. I was hoping to take them
Sure,
a
yeah.
little
I'd
bit
like to keep it
later.
interactive.
Yeah.
So
Yeah, if you guys have some question, go ahead and type it. I see some question there, but I was trying if I have a question that's already answered that question. That's why I didn't ask it. It was Michelle Fouquet
okay.
asking, hi Michelle, that's the first time here. Thank you for joining. How is underwriting looked at differently for new investors with regard to underwriting? And I do have that question at the end. So let me go with the other question that I have. So I
Okay.
have a key question for you. So if we wanted to truly get into the mindset of a lender or underwriter, right?
Mhm,
What are the key questions we should be asking ourselves before we even bring a deal to that person?
mhm. Yeah, so let's just assume like you're at a stage where, okay, I know I can confidently answer the questions around my background, my team's background, our executional track record, right? Ability to operate and deliver as per projections. Really, the next set of questions is to think through the downside, right? What could go wrong with the deal? Is it conservatively underwritten based on rent assumptions, uh, based on the expense assumptions, right? Is the deal adequately capitalized, right? Do I have sufficient reserves? Do I feel confident in my ability to raise, right, the remaining equity to ensure that, again, there are no shortfalls after closing? And does that debt structure align with the business plan, right? I saw a deal not too long ago. It was pretty much stabilized, but they were getting bridge debt, and I was like, why why would you do that? It's now, of course, the part of the reason why it's higher leverage, shorter term, so the return profile looks different. And as long as the cash flow is there, the lender will probably have that risk tolerance to do that. But really thinking through, does that debt structure align with the business plan? And last but not least, what happens if things go wrong? Do I have adequate access to outside capital, perhaps through my personal balance sheet or other partners' balance sheet, to step in and save the deal? Because especially in the current environment, right, a lot of people either have maturing bridge loans that are coming due, or maybe loans that are expiring and they're hoping to extend for another year or two to weather the market, and they think, yeah, I'll just talk to the lender. And my one of my pet peeves is with bridge debt, right? People say, oh, it's 5 year. No, no, no. 3 year with two options to extend, but these are options, not obligations, for the lender to extend the loan. And if that's the case, it's a two-way street. It's not going to be just a straightforward extension. Again, they're a partner, right? So in the current environment, they'll likely be looking for a pay down. So thinking through the leverage profile of the deal, thinking through the cash flow of the deal, which very much drives the loan sizing these days. How have you been behaving throughout the deal? If you've been communicating proactively, right? If you've been paying your loan on time, if you've been in compliance with covenants, if you have the liquidity to bring to the table when you refinance, and again, in the current environment, that most likely will require loan pay down for most deals out there, then you're probably in a pretty good position, right? But if you're not communicating to the lender, if you're hiding information, if you don't think you can bring anything else to the table, because again, these restructures, like I said, are a two-way street. So if they'll give some, but they'll also take some, right? It's a give and take relationship. So thinking through that ahead of time would be key. And I think probably one common situation that I see a lot these days is it's kind of like the chicken or the egg, right? When you go to those negotiations, you have to have a pretty good idea how much capital I can bring to the table. And if you don't have a ton of liquidity or access to additional liquidity at the personal level to bring, in most cases, that means capital call. So then you have to feel fairly certain, right? How much of that capital call money from the capital call I can raise from my investors, because maybe LPs won't participate at all, or maybe they will, and it's, well, how do I go to LPs if I don't know the terms of my new deal? So it's a lot of like conversations that you have to finesse up front and at least get a general idea of what that may look like, so you can approach these conversations proactively and not reactively.
Right. So, good. As far as risk, because that's an area that a lot of time people really underestimate.
Mhm.
Where do you see investors most often underestimating risk?
Um, well, a couple of areas, again, apart from who the operator is, and I can definitely speak to that because maybe I'll just make one big comment there, because very often, especially in our industry, right, as an investor, you may end up talking to one of the capital partners, or maybe whether that's co-GPs or fund managers that are maybe not directly involved in the deal. They may be absolutely fantastic at marketing and sales, but maybe not as strong when it comes to accounting, finance, and operations. So really going through the diligence, and actually in my book, I share a very detailed list of questions to ask, so you can determine what their level of expertise is, to really run and operate the deal. And if you happen to be talking to one of those capital partners who, for whatever reason, is maybe not as familiar with the deal, then the next step would be to get on the phone with the operator and ask the questions you need to ask. So that would be one. The second piece, like I said, is the underwriting, and I understand it can be intimidating, but part of the reason I wrote the book is, well, first of all, it's in plain English, but the premise behind it was that you don't have to be a Wall Street analyst or CFO to be able to analyze a deal. Anyone can learn it. Of course, with patience and practice, right? But anyone can learn how to vet a deal. And I feel that that is a really important first step to take, meaning to educate yourself on how to analyze the deal. And then reading the private placement memorandum, which includes the operating agreement that effectively tells you how the investment is structured and how it will be governed. Because the last thing you want is, let's just say, in a capital call situation, you get there and you realize, oh, it's actually mandatory, and now I have to contribute, or else not only I get diluted, but I also get penalized on top of it, right? So it's those things that you can take a look at up front, and so there are no surprises later, right, down the road. And probably the last piece I would say is, we talked about operators, but also their ability to communicate openly, frequently, and transparently. And you can gauge some of that by maybe asking for copies of their reports. So you can determine, does that level of detail meet my criteria? So like, I happen to be very detailed oriented, so I like details, but if you're someone who is okay with talking to them once a year and maybe reviewing the reports once a quarter, and you want the top 5 bullet points, that may be okay with you, right? So depending on what your information needs are, that's also something important to vet up front, because again, you don't want to feel surprised and then taking a step back, realize, oh, geez, I could have vetted all of that up front and saved myself a few of those maybe not so pleasant surprises.
All right. So thank you about that, for this answer. And that's something us, either as operators or GPs or aspiring GPs, we need to know those things because we go in front of those lenders every day. But a lot of time, if you come in, the best way to understand somebody is to know what the person is thinking, right? But when you come in from your own perspective and we get in front of that person, and that's where we create a conflict if we do not understand each other.
Mhm.
Michelle, are you here? I would like you to ask your question. Go ahead and um unmute your mic and go ahead and answer and ask your question, Michelle.
Hi, thank you very much for having me. So my question was from an underwriting and track record perspective because Vessie spoke on that specifically. For a new investor with no track record, how is the underwriting looked at differently? Are there different things that are analyzed or different questions? What do you look at differently?
It's an excellent question, and really appreciate you raising that, Michelle. So it's, at the end of the day, this is also a team effort, right? You're likely, in most cases at least, you're not going to be a solo operator. So that's where you can lean in on the experience of the team. And in most cases, right, for the deal to get approved, you likely need to have at least one key principal, right, with the experience level, at least one that has that balance sheet and the liquidity requirements. So it's not all on you, right? So that's where you're speaking collectively as a team, right? This is what we've accomplished. This is what we've done. This is my specific role. Maybe now you're underwriting the deal and sourcing deals, but one is a key principal with balance sheet and experience. The other is um, an asset manager. Really talking through your profile collectively as a team will give them that comfort and experience. And in most cases, they wouldn't want to see a solo operator, frankly, because just like as investors, right? We think about key man, key woman risk. The lender thinks through that component as well. Well, what happens if tomorrow you become incapacitated and you're no longer around? So who would run the deal? Lenders are not in the business of renting property, so that's the last thing they really want to do. So leaning on the power of team would be key in that scenario.
That is so good.
Thank you.
And
Mhm.
you are correct. And even when you are in a deal, and even you as a partner, if the team is really small, it's some you really need to understand each other. If
Mhm.
because I remember at BEC there was a question like that they had over there, and that question was they were asking the guy who was presenting the deal if something happened to you today because he was showing how he was the one doing everything. If something happened to you today, then what happened? Then he did say, but my partner can do the same exact thing that I'm doing. And my
Mm-hmm.
team is trained to do exactly what I'm doing. So if
Mm-hmm.
something happened, then they can take over. So that is very, very
Absolutely.
important. Yeah,
Yeah,
like
it's
the
that,
same.
and I would also add, and hopefully that's a team you've been working with consistently, right? Like not hopping around from people to people. You have like three different people across each deals, right? So the consistency factor is also important, and that's probably one of the hardest part of whether you're investing actively in part or passively. It's really finding your partners, and there's no perfect way to vet for that, but one of the reasons, there's 5 reasons I typically see deals fail, and failed partnerships is one of those. So don't rush into a deal. Get the time to know those people that you're partnering with, because yeah, I mean, deal tenors are what, 5 to 7 years in syndication. So you could say these are timed marriages, right? You know exactly when they expire, but 5 to 7 years is a long time to be in a bad relationship. So definitely take the time to vet those people, and again, make sure you have complementary skills too, right? If all of you are underwriters, who's gonna run the deal? Who's gonna raise the capital, right? Like, so there needs to be also a good balance of skills and some level of overlap for continuity purposes, but also a good level of complementary skill set.
Yeah, that is true. You really need to know each other, and you also need to complement each other as well, because having the same skill set, then the other stuff gonna be left alone. Who's gonna take care of them?
Mhm.
The other tasks and activities that you need to do in order to get that property to the next level.
Mhm.
So, Joseph, I see you asking a question. I really do not understand the question. Do you mind asking your question? I don't know. You came a little bit late. I don't know if you understand, because your question is, what is the preferred return? So, um, Joseph, are you there?
Oh, yes, I am here.
Okay, can you
I'm
please
kind of,
ask your question, because I
yeah, my
don't
question
understand.
is, what's the lenders, these lenders expect when, from their investment? That's what it is, the return on investment. If it's
Uh,
a,
the- I mean, yeah, the
yeah,
lender typically has certain profit targets internally, right? They won't
exactly.
necessarily share what they are, but yeah, they don't work for free. So there's definitely margins that are baked in, like fees, right? The loan spread. This is pretty much how they make money, right? It's the fees and the loan spread. And so depending on the risk profile of the borrower, of the market, and the deal, that's how the deal, that a lot of that will actually drive the deal structure, because very similar to an investor, right? If they're taking on higher risk, right, then you can expect the fees and the spread to be higher to compensate for the higher level of risk that they're taking, right? And so oftentimes when you get a term sheet, you may see, oh, if I'm willing and ready, willing and able to live with a higher debt service coverage covenant of say 135, I may be able to get better pricing, right? Because the higher covenant level reduces the risk profile of the deal, all else equal. So the lender will be able to price that accordingly. So it's again a give and take relationship, but they definitely take that into consideration. And if I've been in cases, right, where I mean, lenders would compete, especially in up markets and in strong markets. That's where the spreads get really thin. And I've been in situations where the pricing just didn't make sense for our internal parameters, right? Each lender has their own guidelines on how low they'll go. And so in that cases, you walk away from the deal because it's not adequately priced relative to the risk profile. Hopefully that provided a perspective, Joseph.
Yeah. Yeah. So
All right.
what's their, is there any limits on their investment? Any limit can
Um,
money.
So on there, on how much they lend, absolutely. And I love that you asked this question because a lot of times people think, oh, it's the LTV and it's 75%. It's like not necessarily. That is one of the parameters that they look at to size the loan. But they ultimately, specifically for stabilized deals, right? They would ultimately underwrite it based on the cash flow the deal is producing. And so that's what they'll use to size the deal. And there are two parameters that they look at in that case. One is the debt service coverage ratio. Again, typically the minimum is 125, but when they close they want you to be at least above that 125. They wouldn't want you to be in default, right, within a year. So they're 125 plus a buffer. That's one way to look at it, and then they would adjust the loan proceeds accordingly to make sure you can meet that covenant level based on the numbers you're sharing with them. And another parameter is that not many people talk about, but lenders are looking at it very close, is the debt yield. And you can think of the debt yield as the inverse of cash flow leverage. And that's effectively your NOI divided by the loan amount. And what they're looking for there is, okay, all else equal, right? If that same NOI continues, how fast can I get my principal paid back? And so obviously the shorter, the better. But they would look at that parameter as well. And whichever the lowest of these three is, that's where the loan proceeds will fall. So typically when you get the appraisal, you can figure out exactly where you're going to land, because that will tell the lender almost everything they need to know to size the deal, to size the loan.
Thank you.
Mm-hmm.
Well, thank you as well. So we are at the top of the hour. This is we took a little bit of time earlier in the beginning, and as you guys know, we never start until 2:05, open the room. So I have that very, it's like a closing question. Vessie, if everyone on this call could walk away with just one shift in how they approach deal, what would you want that to be?
That's a great question. So with respect to approaching deals, I would say don't be afraid to say no. No, this is so hard to do, especially when you're under time pressure, maybe as an LP. There will always be a next deal, I can promise you that. But the worst situation that you get yourself into is is a deal where you lose money, right? Because that it will take you twice as long, right? And you have to find deals that produce twice as much the return just so you can break even. So think about protecting the downside, protecting the principal first. Listen to your gut. That's real. It's not quantitative. I can't explain it, but if something doesn't feel right, don't be afraid to walk away. And trust me, you'll be much happier down the road if you missed on an amazing deal versus if you got into a really bad one.
Really good. Well, that was really, really good. I always tell people all the time, I doing this to educate other people, but
Mhm.
I think I get way more in these things than my audience.
Well,
And
education is
I really
key.
love it. Yes,
Yeah,
yes. And
education
I
is
love it.
key, and I love that you're hosting these meetups, Susie, because that's where I feel sometimes people get enamored, right, by the shiny object, or you talk to a friend and they're in a deal, and you take your friend's experience as a endorsement, right, of a certain sponsor or deal. But just because a deal was right for them doesn't mean it's going to be right for you. So it's okay to slow down, take a step back, educate yourself, because you're your own fiduciary, right? You're putting your own capital to work. So it's important to take the time and do that due diligence, deep due diligence up front, because that's also how you, at least partially, right, mitigate the risk of loss.
Yeah, you are correct on that one. So, Vessie, people asking about the point of how they could contact you. She's very active on LinkedIn. I would say that's one place to start. But
Mhm.
I don't know, Vessie, if you like to tap your email in there, if people want to reach out to you, something like that. But the next thing, we usually take a picture at the end. I would
Mhm.
like everybody to put their camera on. I think the people that are usual here, they know.
I will do
Put your
this too.
camera. Oh, yes.
Yes,
About her book. You have, yes, she has a new
we
book.
can
That
put
book
it in
came
the
out in
picture.
December. That your book came out in December or November? When did your book?
It came in December, and it's actually now an Amazon bestseller. It's called
Yeah,
Mastering
sent Amazon.
Multifamily Underwriting. So, a lot of the checklists, a lot of the actually points that I made during today's call, I dive deeper into them in the book, and it comes with a ton of additional resources. So it's still available on Amazon, where you can get your print, digital, or audio copy. But I'll keep that for the photo, since you mentioned we'll be taking one
Oh
now.
yes, okay, that would be good. Okay, that's a good point. Yes, we'll do that. Master in Multifamily Underwriting by Vessie. Vessie did not bring a lot of those books at BEC, so I couldn't get a book and get it signed. So I have to be like you guys going on Amazon. I have not purchased mine yet, but I wish you'd have bought some when I saw her last time.
Thank
So
you.
okay, so I put the book in there. So if anybody wants, I have a couple things, guys. As you put in your camera on, I'm looking, somebody reached out to me recently and looking for a hotel deal worth $100 million. And it has to be in the East or West Coast. Don't really need to be performing or occupy. They'll take it as is, but it has to be near water, not exactly on the water, but near water. No Midwest, nothing in the Midwest. Southeast included, East Coast and West Coast. So that is, if you guys know any broker or anybody who may have a deal like that, please reach out to me and we'll definitely make something work. And that is one thing. What was the other thing? Follow me on LinkedIn. Vessie is also on LinkedIn. LinkedIn is a great way to raise money, to raise capital. And put your camera on. And before you do that, we need to really thank Vessie for all those. She was very generous with her time today to be here. So Vessie, thank you. This was not just about underwriting. It was about learning how to think, communicate, and present deal at a higher level. Your insight help bridge the gap between investors and lenders, and that's incredibly valuable for everyone in this room. We truly appreciate you taking the time this Saturday morning to pour into this community. I mean, you have no idea how much is, especially I gave you really short notice, so that was really great.
No, it's my pleasure. I love doing that. I love speaking with investors, and like one of my missions, right, is to create educated and empowered investors. So if events and communities like that very much align with what I do. So I appreciate the opportunity to be here and to contribute.
All right, thank you so much. I'm going on the gallery. So
Okay.
everybody put their camera on. How many people here? I only see a few faces. The other people, oh, Eve is here twice. That's what that is. Kevin, Michelle, can you put your camera so I can take a picture? Kuye, Pam. People don't like to take pictures. People, show your beautiful face and let's take a picture. All right, let's go ahead and take a picture. Um, so this is picture time. So now I need to find my stuff. Okay. Smile. Right
Go
now,
ahead,
your
Suze,
picture is
go
very
ahead.
important. That's how I still have some pictures, okay? So your pictures can leave after you. Make sure you take that picture. It's, all right, so let me get this. Uh, okay, okay, well, hold on, guys. There we go. All right, we have a beautiful picture, and that picture will be posted on LinkedIn tomorrow.
I've been
And
laughing for 5 minutes.
so that picture will be showing on LinkedIn tomorrow on my post. And thank you so much for being here, every single one of you. I mean, there's so many places you could have been in the world, but you decided to be on Multifamily on Zoom. And let's meet again next week for a beautiful session like this. Thank you so much, everyone. Have a great rest of your day. Bye.
Thank you.
Bye-bye. Thank you.
Bye, bye,
Bye.
bye.